Hello everyone, I'm Joe Cherian, and today we're going to learn about 3 investment criteria about investment decision making under conditions of uncertainty. The 3 are NPV, IRR and payback. Let's get started. A project's payback period is found by counting the number of years it takes before the cumulative cash flow equals the initial investment. It's as simple as that. Just count the cash flows and use the initial investment and look at how many periods are required to cover the initial investment. The payback rule states that a project should be accepted if its payback period is less than some specified cutoff period. Let's do an exercise to fix ideas. Let's say Maybank has an opportunity to purchase some equipment that will result in labor savings of approximately $11,000 a year. So think of the savings as a cash inflow to the firm. It's a positive cash flow. $20,000 to purchase the equipment, and that expected savings from the purchase of the equipment is about 3 years long. So $11,000 savings over 3 years. The cost of the equipment that provides that savings is $20,000. So the bank wants to decide if the proposed investment is financially feasible using the payback criteria. You may ask me at this stage, what's the cutoff period? Well, let's say Maybank says it's 3 years, the cutoff period. So we now have to do the cash flow analysis. So the answer is very simple. 20,000 divided by 11,000 is 1.81 years. So we know that Maybank requires 3 years payback, and this falls within that period, which means that it is a go. Now let's look at another criteria called net present value. Net present value is what we use for almost every decision making on investments. The reason is because it aligns all the cash flows associated with the project. It discounts it by the risk adjusted rate, which is very important. You need to discount it by the opportunity cost of capital associated to the cash flows. And that's what NPV does, and you've got to do it over time. So let me explain to you once again by just repeating it, because this is very important. R reflects both the time value of money, that cash flows are paid at different points in time, and the risk involved with those cash flows that are associated with that project. So we call R the opportunity cost of capital or the risk adjusted rate of return. We will learn how to calculate this risk adjusted return in other classes, not in this one. In this class, we're just going to give you the risk adjusted rate of return. C0, C1, all that C's are the cash flows associated with the project. Be sure you put a positive or negative sign depending on whether it's a cash inflow, positive, cash outflow, negative. Okay? The time span over which the cash flows are generated could be 3 years long, 5 years long, and so on. So rule, choose the project with the positive NPV as well as the largest. So if you're comparing 3 projects the same firm can take on, you would look at the NPV that's the largest, and that's the project you go with. So let's do an example. So Maybank has an opportunity once again to purchase some equipment that result in labor savings of approximately $11,000 a year. The equipment costs $20,000. This problem looks familiar to you. It'll produce labor savings for 3 years. Now we have to remember it takes 3 years for that savings to be realized, as well as the discount rate. I told you the time value of money requires a discount rate or a risk adjusted cost of capital, and we shall say to you that 6% a year. You don't have to calculate it, we give it to you. So how do we do the calculation? Well, let's line everything up. Way of doing things is to write everything down, maybe even draw the timeline, and then solve the problem. So first thing is, the annual incremental cash flow from the labor savings is $11,000. The economic life is 3 years. The net investment amount is $20,000. So remember, this is negative, $20,000. And the rate of return, or the risk adjusted rate of return, is 6%. What else do we have? The formula. NPV is given by minus $20,000, which is the cost of the equipment, plus $11,000. You see 11,000 appears 3 times because it's 3 years of savings, and we discount it at 6%. For the first year, 1.06. For the second year, 1.06 squared, and the third year, 1.06 cubed. If you did this formula and plugged it into your financial calculator, you'll get the answer of 9403.13, which is greater than 0. You notice I said 1.06. The reason I say that is because when you put it into a formula, you've got to change the 6% to 0.06, okay? So just be careful of that. If you put it into Excel or into some other device, you may be able to use 6% because the device automatically converts it to 0.06. But if you're plugging in and doing it manually by formula, you have to change it to 1.06, okay? What this says is that because the NPV is positive, we accept the project.